Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at RCAT Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really does help us out.
Absolutely. And today is going to be a fascinating one because we're looking at a company that is, well, it's sitting at the absolute intersection of three massive forces: geopolitical tension, government regulation, and just explosive execution.
You know, I was going through the notes on this one, and honestly, I had to stop and just recalibrate my expectations.
I get that.
Usually when we talk about growth stocks, we're talking about maybe 20% year over year. If it's a really hot tech company, maybe, 40 or 50%?
Right, that's considered great.
But the number attached to RCAT right now, I actually assumed it was a typo in the spreadsheet until I pulled up the primary filing myself.
It is definitely not a typo, but it is shocking to see on paper.
You've got down here 646% year-over-year revenue growth for Q3 2025.
646%. I mean, that's just astronomical. It's the kind of number you usually only see in, like, crypto or penny stocks, not in a defense contractor with actual hardware.
Exactly. And that's the hook here. We aren't looking at a company that's promising to build something cool 5 years from now.
Right.
We are looking at a company that is experiencing what we call explosive revenue acceleration right now. It's a complete shift.
So let's unpack that number, because headlines can be deceiving. I mean,
Okay.
646% sounds great, but if you made $10 last year and $100 this year, that's huge growth, but, zero relevance. What's the actual scale we're dealing with?
That's the right question to ask. We have to look at the preliminary guidance for Q4 2025, which is the quarter wrapping up right now. They are guiding for revenue between $24 million and $26.5 million.
Wait, just for that one quarter?
Just for the single quarter, yeah.
Yeah.
And put that into context, because context is everything here. The analyst consensus, what Wall Street expected, was sitting at roughly $20.9 million.
So RCAT isn't just growing. They are beating the street's expectations by a margin of 15 to 27%.
That is a massive beat. Usually a 2 or 3% beat is considered a good quarter.
Right. And if you zoom out and look at the full year for 2025, that guidance points toward about 124% total growth. So to answer your question about scale, this is the moment. This is where the company transitions from being a prototype story.
Yeah, showing off cool drones at trade shows and burning cash.
Exactly.
Yeah.
They're moving from that to a mass production execution story. They're actually shipping units.
And that is the hardest leap for any hardware company to make. I mean, look at the history of EV startups. Building one car is easy.
Building 10,000 is a nightmare.
Exactly. It's one thing to build a prototype drone. It's another to ship $25 million worth of product in 3 months without quality control just falling apart.
Mm-hmm.
But I want to pivot to the why for a second. Because you can have the best drones in the world, but you don't get 600% growth just because your product is shiny. What is driving this demand? Is this just general defense spending?
It's defense spending, but it's much more specific than that.
Yeah.
This is where the story gets really interesting from a regulatory perspective.
Yeah.
You have to understand the moat they have right now. It's not a moat built on marketing. It's a moat built on law.
You're talking about the changes in the NDAA, right? I was reading up on Section 1709.
Exactly.
Hi.
The FCC's enforcement of Section 1709 of the National Defense Authorization Act.
So for those listening who, don't spend their weekends reading congressional bills, Section 1709 is essentially an eviction notice for Chinese technology in the defense sector.
That's a good way to put it.
It effectively grounds Chinese competitors from the U.S. market. And specifically, we are talking about DJI.
That's the key. For years, DJI was the dominant player in drones globally and in the U.S.
Yeah.
They had the market cornered, cheap, effective, everywhere.
Right.
But because of data security concerns, fears that data from these drones could be sent back to servers in China, the U.S. government has just said, no more. You cannot use Chinese-made drones for government or defense work.
And that just creates a massive vacuum. You have every police department, every military unit, every border patrol agency suddenly needing to replace their fleets, and they literally aren't allowed to buy the market leader.
Precisely. It creates a de facto monopoly for American-made NDAA-compliant drones. And we are talking about a market government procurement and defense that is worth over $10 billion annually.
Wow.
It's a forced migration of capital from Chinese tech to American tech.
And RCAT is just standing there with the door wide open. But this brings up the product question. Just because you're American doesn't mean you're good. I was looking at the specs for their Black Widow platform.
Hmm.
It seems like they aren't just trying to copy DJI, they're trying to change the doctrine of how these drones are even used.
That's a great observation. The Black Widow isn't just a flying camera. It's built for what we call swarming and high-level autonomy. The proprietary software allows a single operator to control multiple drones at once.
Which is a huge force multiplier.
A massive one.
Yeah.
In a tactical situation, you don't want one soldier staring at one screen, flying one drone. You want a system that provides intelligence autonomously.
And are they actually able to keep up with the orders? Because if everyone suddenly has to buy American, the lines must be out the door. I saw a note about lead times being around 6 to 7 weeks.
Which is actually a sweet spot.
Explain that. Why isn't immediate shipping better?
Well, if they were shipping immediately, it would mean they have inventory sitting on shelves gathering dust. No demand.
Okay, that makes sense.
If the lead time was 6 months, it would mean their supply chain is broken and they are losing sales. 6 to 7 weeks indicates really strong demand. They're selling everything they make, but it also shows they have supply chain control. They're agile.
And that's their advantage over competitors like AeroVironment. I mean, AeroVironment is the big dog in this space, obviously. Switchblade and all that.
They are much larger, yes,
Yeah.
but they're also slower. They focus on these larger loitering munitions. RCAT has agility in this specific niche small tactical reconnaissance drones. The analysis suggests RCAT has a solid 2 to 3 year competitive advantage window here.
While the giants try to pivot and catch up.
Exactly.
Okay, so we have massive growth, we have a government-mandated monopoly, essentially, and we have a product that is shipping. But, and you know I have to do this, I looked at the bottom line.
I knew you were going there.
I have to. I see red ink, lots of it. The trailing 12-month loss is sitting at $90.46 million. That is a massive number for a company of this size.
It is.
Their earnings per share is negative $1.01. In Q3, they missed EPS estimates. So, playing the skeptic here, is this company just burning cash to keep the lights on? Are they selling dollars for 90 cents?
It's a fair observation, and if you just look at a spreadsheet without context, it looks scary. But you have to distinguish between burn and investment. You have to look at why they are losing money.
Okay, defend the loss.
Well, the argument here is that this is an inflection point. These losses aren't because nobody's buying the product. We just established demand is through the roof.
Right.
The losses are a function of R&D and, more importantly, the manufacturing ramp-up.
Building factories is expensive?
Extremely. They're currently doubling their production space. They're launching a whole new maritime drone division that requires upfront capital expenditure CapEx. You spend the money now so you can ship the $25 million in product next quarter.
So it's the classic spend money to make money phase. It's growth CapEx, not distress CapEx.
Exactly. And here is the path to profitability. With the revenue run rate hitting that $24 to $26 million range per quarter, they are starting to see operating leverage if they can stabilize their gross margins above 40%.
Which is pretty typical for defense.
Very typical once they hit scale. If they do that, positive cash flow is likely only 2 to 3 quarters away.
That soon? That surprises me given the $90 million loss figure.
That's the power of 600% growth. Analysts are projecting a 50-cent loss per share for fiscal year 2025, but that baseline assumes losses continue at the current rate. It's likely too conservative.
Because it doesn't fully account for how fast that revenue is surging.
Right. When you grow revenue that fast, you absorb those fixed costs very, very quickly.
So the argument is that the revenue wave is going to wash away the fixed costs in about 6 to 9 months.
That is the math.
Let's talk about the stock price itself, because the chart has been looking pretty interesting lately.
Right.
We recently broke an all-time high of, what, $16.71?
We did. It's been a rocket ship.
And it's trading way above the moving averages. I checked the charts this morning. It's at a 71% premium to the 200-day moving average. For anyone following the technicals, that usually screams overextended.
It can.
It means the stock has run up very fast, very quickly. Does that worry you? Is a pullback inevitable?
It is definitely a momentum play right now. But what's fascinating is what happens when it dips. On January 23rd, we saw a 7.5% drop.
Okay.
In a weak stock, or a retail hype stock, that drop triggers a panic sell-off. In RCAT, it was bought up almost immediately.
Which tells you there is real support there. It's not just day traders.
Exactly. And speaking of support, this is probably the biggest validation point we have found. This isn't just a retail stock anymore. We have the smart money entering the room.
We're talking about institutional flow.
Yes. Specifically, BlackRock.
The BlackRock.
The BlackRock. They recently filed a 7.3% stake in the company.
Wow, okay. When BlackRock takes a 7% chunk of a company, they aren't day trading. They aren't trying to flip it for a quick buck on Reddit hype.
No, they are parking capital for the long term. And it's not just them. Truist Financial, Rockefeller Capital Management, they've all entered new positions recently. Institutional ownership is now nearly 38%.
That just signals a complete shift in perception.
It does. The big players believe this execution story is real.
That changes the complexion of the stock entirely. It provides a bit of a floor. Retail investors might panic sell on a bad headline, but BlackRock just accumulates.
Precisely.
So where do the analysts see this going? We are sitting around the mid-16s right now.
The consensus is a buy rating with an average target of $19. But if you look at the technical trend following targets, if this momentum continues, we could be looking at 22.50, maybe even 23.25 in the near term.
That is significant upside. But look, we need to be responsible here. We can't just paint a rosy picture. There's a pretty big elephant in the room regarding a lawsuit, isn't there?
It is not, and we cannot ignore it. There is a shareholder lawsuit alleging misrepresentation of production capabilities.
Essentially, the lawsuit claims they lied about how many drones they could build to pump the stock, right?
That is the core allegation. They claim the company misrepresented its ability to fulfill a key U.S. Army contract.
That sounds serious. I mean, if that's true, if they cooked the books or lied about capacity, the stock crashes. A 30 to 50% correction would be conservative.
It would be catastrophic. It would break all trust in management. However, and this goes back to what we started with, look at the Q4 guidance.
The $26 million number.
Exactly. That is the mitigation here. You don't guide for record-breaking revenue if you can't build the drones. The fact that they beat consensus guidance so significantly suggests that production is scaling.
So the numbers are essentially their defense against the lawsuit.
Right. If they hit those numbers in the audited financials in March, it likely invalidates the premise of the lawsuit. It's hard to argue a company can't produce drones when they just delivered $25 million worth of them.
But until those audited numbers are out, it is a risk factor that hangs over the stock.
It absolutely is.
And what about the cash burn? You mentioned the path to profitability, but they are burning $16 million a quarter right now. Is there a risk they run out of money before they hit that inflection point?
There is a debt burden. They need to reach that positive EBITDA earnings before interest, taxes, depreciation, and amortization by Q4 2026. If they miss that target, they might trigger debt covenants, or worse, have to do a capital raise.
Which means diluting the shareholders, selling more stock to raise cash.
Exactly. And nobody wants that. So the clock is ticking. They have about a year to turn that corner. It's a race against their own balance sheet.
Okay, so the stakes are high, but the potential is huge. Let's look at the calendar. If I'm holding this stock or thinking about buying, what are the dates I need to have circled in red on my calendar?
We have a very busy schedule coming up. The first one is right around the corner, February 13th, 2026.
That's just a couple of weeks away.
Q4 earnings. This is the first test. We have the preliminary numbers, that 24 to 26 million range, but we need to see the final validation. If they hit it, it confirms the growth thesis. If they miss, the lawsuit fears come rushing back.
Okay, Feb 13th is the reality check. What's next?
February 27th, 2026, Innovation Day.
That sounds like a classic corporate hype event.
It is, but in a good way. They're doing live demos of the Black Widow and the new maritime drones. In this industry, seeing is believing. If the tech looks good, if the demos are flawless, that drives what we call institutional FOMO.
Fear of missing out. Even the bankers get it.
Especially the bankers. And then shortly after that, March 6th, this is an interesting one for the traders. It's options expiration day. There is very high open interest at the $18 strike price.
Explain that for the listeners. Why does the $18 strike price matter?
When there's that much betting activity at a specific price, $18, it creates a magnet effect. Market makers who sold those options have to hedge their positions by buying the actual stock as the price rises. It can pull the stock price up toward that level.
A gamma squeeze, essentially.
On a smaller scale, yes. And then finally, March is the truth moment with the audited financials. That's what puts the legal concerns to bed one way or the other.
So we have a packed quarter. Sounds like there isn't going to be a dull moment for RCAT holders.
No, it's going to be volatile, but the trend is clearly upward.
So let's wrap this up with a verdict. You've laid out the massive growth, the government moat, the smart money buying in, and the risks. How are we looking at this?
Based on the synthesis of everything we've talked about, I view this as a high-conviction play for the near term, the next 3 months, and medium high for the long term, looking at 12 months.
Let's break that down into a trading plan.
Sure. If you are looking for a swing trade, you are playing the run-up to that innovation day on Feb 27th. The momentum is there. The chart is strong. I'd be targeting an exit around $20 to $22.
Ride the hype, sell the news.
Exactly. But if you are a long-term holder, if you believe in the American drone monopoly thesis, you are holding for 6 to 12 months. You're waiting for that profitability crossover in late 2026.
And in that case, what's your target?
In that case, you are looking for a target of $25 to $30.
That's a potential doubling from where we were not long ago.
It is. The shift is happening right now. We are watching a company go from speculative to execution, and those are usually the most profitable times to be involved.
It certainly feels like RCAT is one of those rare stories where the macro environment, the geopolitics, and the company's execution are lining up perfectly.
They are. But, as always, execution is everything. They have to build the drones, and they have to ship them.
That's the bottom line. Well, that is a lot to digest. 646% growth is going to be stuck in my head all day. We'll be watching those February dates very closely.
Definitely.
If you found this breakdown useful, please remember to subscribe and leave a comment. Let us know, are you buying the RCAT story, or is the lawsuit keeping you on the sidelines? We'd love to hear your take.
And just a reminder, this is analysis, not financial advice. Do your own research.
Thanks for listening to Smart Wealth with Joshua. We'll see you next time.